Welcome back to our intermediate financial accounting class. Over our last few segments, we've been talking about other gains and losses, specifically from the purchase, sale, and market value adjustments for the stocks and bonds that we own as a company. That means that we are moving forward in our overall discussion of this last piece of the income statement, wrapping up the calculation of net income and earnings per share. So now that we've talked about other gains and losses, we get to turn our attention to one of the most important and most challenging, or as I like to say, most fun discussions on our income statement, and that is the calculation of our income tax expense. We've kept it really simple up to now, but we get to now start talking about the differences between GAAP reporting and IRS or tax reporting and how those differences get shown on our financial statements. Before we move into a discussion of taxes, we do need to take just a minute and talk about why they're so important. And the biggest reason taxes are important is because they're part of absolutely everything we do in business. We like to ignore taxes in accounting classes, especially financial accounting and cost accounting classes, where we'll make an assumption, just ignore the effects of taxes for this problem, or assume that the tax effects will be the same for all of the different decisions that we're considering. Well, the truth of the matter is that's not the case. Taxes are very much a part of all business transactions, so you can't really just assume them away. And they are different for different options. Even if you think they're going to be the same, we're in a 25% tax rate period and we're just going to roll through for the next 10 years versus this other project that's 15 years, well, the tax rate could change. And I might roll into different states or into different countries that have different tax laws. And that's going to change my tax calculations, especially for that longer horizon project that's not going to end for 15 years. So as much as we like the simplification of saying, don't worry about taxes for this problem, the reality is we have to think about taxes for every problem. Now, the good news for us as financial accountants doing GAAP as opposed to accountants focusing on IRS rules and tax law is that we don't really have to be experts in all the different details of tax. All we need to really understand is how the numbers we get from the tax department are going to affect our financial statements. And that's the big piece for us. I don't expect you to become tax experts. I just want you to be comfortable and confident in understanding how those numbers are going to roll into the financials. And it hits all of the financials. We show a large income tax expense item on our income statement that changes our balance and our net income and our earnings per share and all the key ratios that come out of the income statement. On the balance sheet, we've worked a lot with income tax payable in the past, different examples that we've done and projects that we do. But there's also the possibility of income tax receivables, where the government owes us a refund and that money could be coming in. And also what we call deferred tax accounts, where we are going to have to pay taxes later, or we prepaid our taxes and eventually that's going to reconcile and I'll owe more later, or I'll get a tax break, or anyway, we'll talk about that in more detail. But these are big accounts on companies' balance sheets as well. So there's several accounts with large balances that show up on our balance sheet because of taxes, and then change all of the ratios that come out of our balance sheet. The last piece, of course, is our statement of cash flow. And because we're paying taxes to the government, well, there's a cash flow effect from our taxes as well. And just like we talked about in earlier examples, this cash effect can show up in two ways. If we're doing a direct method, statement of cash flows, we would show an actual line that looks like the one down here at the bottom. We would show a cash paid for taxes, or as taxes, and that line item would show the exact amount we remitted to the government as tax payments for the year. And that method is really clear, it's really straightforward, and it's really FASB's preference because they like the fact that it's a very clear-cut number. And I should mention right here that under IFRS, you show that line item always, regardless of whether you're doing direct or indirect. They actually have you break out taxes and show cash paid for taxes, no matter which style of statement of cash flow you're doing, which is kind of interesting that they find that number so important. But under the indirect method of US GAAP, if you remember from our earlier discussions, we're starting with net income. We're making a series of adjustments, and those adjustments are going to turn that net income number into cash flow from operations. So if we're looking at our cash effect of taxes, what we have in our income statement that's part of net income is income tax expense. And let's say we showed that as being $100,000. And of course, that's a negative because it's an expense. And then we looked at our cash effect. So cash paid for taxes was only $80,000. And I'm going to abbreviate that since I'm running out of room. Under direct style, I would just show this line item right here and be done with it. Under indirect style, I would need to turn this 100,000 into the 80,000 by having a positive $20,000 adjustment that's usually due to a change in a working capital account. So we call this the change in income tax payable, or it could be for taxes. But we have this change of 20,000, and that's all we see on the statement of cash flow is this positive 20,000 associated with taxes. And we have to be comfortable enough as accountants looking at those numbers to say, okay, I can go back to my income statement, see that negative 100,000 for my income tax expense. I can add in that 20, and I can calculate what the cash paid for taxes really was. Please make sure you're comfortable with how taxes affect all of the financial statements. Understanding just how pervasive tax effects are, how much they flow through the statements, how we see them even on the statement of cash flow, and how hard it is to figure out the actual cash paid for taxes. If you don't know what you're doing, all of that is one of our key concepts, understanding the financial statement effects of taxes. So make sure you're comfortable with it before you move on. Well, because taxes are such an important part of what we do, we really do want to make sure we take the time to understand how taxes work. So let's start out with just some really basic concepts that we need to be comfortable with as we move into a real thorough discussion of income taxes. First off, US GAAP is not equal to tax law or IRS rules and regulations. The rules are different, which leads us to two sets of books. And you'll often have companies talk about this. We have our accounting books and we have our tax books. This has nothing to do with earnings management or manipulation. It's simply trying to adjust for the two different sets of numbers and the rules that are required under these two different sets of regulations. The important thing to remember when you're dealing with US GAAP versus tax law is that US GAAP is based on the accrual concepts that we've discussed many, many times. This is what leads to all those adjusting entries that we make and all the different calculations and closing entries that we do at the end of each period that allow us to keep the cycle moving, even though cash hasn't gone out yet. Most tax law is based on cash. Not all of it, but most of it. And the primary difference that we're going to see, at least from a financial accounting perspective, looking at tax law, is the difference between accruals and cash. And if you'll keep that in your mind, it will make all of what we're going to talk about much, much easier, especially as we get into the methods. Next, income before taxes is not equal to taxable income. Now, in a lot of the examples and projects that we do in my class, have us start with income before taxes, multiply it by a tax rate, and that's income tax expense. And once I have that income tax expense number, I can take income before taxes minus income tax expense and get to net income. That makes a lot of sense. But that's not really how we determine what we owe to the government, because taxable income is based on those IRS rules and tax law, not GAAP. So these two numbers are very different, and they lead to different income tax. So income tax expense is not equal to income tax payable. And we need to differentiate here really quickly. When I talk about income tax payable in this lecture, I'm not talking about the income tax payable account most of the time. What I'm talking about instead is the amount we actually owe the government for the year. So what we're saying in this last line here is that what we show on our income statement as income tax expense does not equal what we show on our tax returns as our taxes payable to the government. Because tax law and GAAP are different, we get very different income before taxes and taxable income numbers, which lead to very different obligations. Under US GAAP rules, we put down an income tax expense based on what we think we should be paying in taxes. And then we have a tax number or a taxes payable to the government number that is based on actual tax law and what we really owe. And that's what causes the big difference. Now, we talked about some really important concepts in this segment. Why taxes are important, how they hit the financial statements, why we've got differences between GAAP numbers and tax numbers. And because of that difference, we're going to have to do some calculations and adjustments to differentiate between what we're paying to the government and really owe the government versus what we think we should be paying under GAAP rules. And when we come back, we'll be talking about how we account for those differences. We'll see you then. Thanks.